Want to go to Charles Payne right now, the Making Money host, best-selling author, just an all-around great person. We've known each other for decades, and we both survived that. Charles, let me get your take, first off, on whether the employment report today seals the deal for rate hikes or puts it off.
Well, I think the deal was already sealed even before this morning. The next real big question mark is how did they lower their balance sheet, and when did they start to do it? You know, a lot of people spent the last decade learning the term quantitative easing. The big question is quantitative tightening, and that's where you're seeing the market grapple with a whole lot of things here. You had the San Francisco Fed head Mary Daly saying maybe they'll hike a couple of times and then they'll let some of the assets that normally expire, you know, and then they buy more. They'll just sort of let them run off the balance sheet, and that's where Wall Street's getting a little bit of anxiety. It comes down the road. Last time they started hiking, they went to this tightening regime. It took them 2 years to let the balance sheet run off. Now they're going to do it a lot sooner. And folks they're not sure what to make of that. And sort of for the knee-jerk reaction as well, let's take a more cautionary position with respect to stocks.
I also wonder, Charles, and you touched on it yesterday, this idea that the Fed will almost always find an excuse not to do the tough thing, to raise rates or to, more aggressively taper and all that, maybe less so on the latter, but that they might resort to what they've done several times before and just go back to all but printing money.
I think it's inevitable. I really do, Neil. Yeah. I think that it's like Dr. Frankenstein. They've created something here. Right now, our assets in this country are 5.6 times GDP. It is absolutely mind-boggling. It is enormous, and you cannot dismantle that. You can't even sort of try to tinker with it. And listen, you've got the wealth effect, which that reflects, and then you also have a federal government with debt approaching $30 trillion. And so do you want to make it where we're spending $1 trillion a year just on the interest of that? Now, you know, I was listening to President Biden before I came to get here wired up, and I got to tell you, it's interesting. He actually mentioned the Fed today. I felt like it was a sort of a nudge. Sort of a nudge. Yeah. He talked about their dual mandate, but I really hadn't heard the president mention the Federal Reserve in a long time. He mentioned the Federal Reserve, and he kind of acknowledged it. They got to take care of employment and inflation, but we also have to do something. I think he's even worried about, you take away the punch bowl, because almost everything he bragged about today was a result of artificial money, whether it's the Fed printing money out of thin air or all of these fiscal programs, including that last $2 trillion bid deal from the president himself. So, you take away accommodation and all bets are off. We've become so dependent on artificial money pumping us up that a lot of folks wonder if we can do it on our own. And the stock market is already telling you, hey, we can't. The Fed can make some adjustments for inflation right now, but they cannot go too far. I know a lot of people are predicting they will. I will not be surprised. And I'm telling everyone right now, don't be surprised if somewhere mid-year, if you see the Fed reverse course.
Wow. Real quickly then, Charles, it seems to me that the Fed will be following the markets on this one. I'm talking about even the stock market. And if the stock market goes into a free fall, they'll do an about face. Will that be the catalyst?
Those FOMC minutes on Wednesday, which actually spooked the market, I saw markets, stock market, equity markets. I saw that all throughout that whole communique. They are certainly watching these markets like a hawk. Yeah. Again, they know that they need the wealth effect. And what is the wealth effect? Even if you're not in the market, when the market's at an all-time high, even people who are not directly in it, because I told everyone watching this show is in the stock market. If you're watching this show, you are either directly or indirectly in the market. They know, just hearing that the market is down 20%, people pull back. And that has this sort of psychological impact on the economy that they understand. It's very real. And listen, they help to create this monster. They can only try to tame it from time to time, but they cannot deconstruct it. The last Fed official who had those kind of nerves, if you will, was Paul Volcker. And we took some serious pain in those days. Could you imagine people having to pay 20% or 18% interest to buy a house, the kind of pain that we took and accepted between Paul Volcker and Ronald Reagan, that first year was ugly. It was devastating, but that's what they had to do to get us on a glide path to many, many years of prosperity.
I'm way too young to remember that, of course, Charles. But you're right. You're right, because I remember Volcker. Remember, half point, 1 full point rate hikes at a time to really, slap down this inflation dragon. It was painful. But it did the trick, didn't it?
It was. It certainly did. It did. But can we endure that kind of pain these days? I don't know. I don't know if any Fed official could. I don't think any president could. So we'll see.
Yeah, everyone's gotten used to it. They like their candy.
Yeah.
Thank you, Charles. Looking forward to see you at 2 p.m.
Thanks,
Eastern
Neil.
Time, about an hour and 40.